నేను ఊరికి చెప్తా అంటానే వెలుగుతాయి దీపాలు. ఇది చూడు.
Flip hike. At GLATION to TH. Chapter 8. Money market and capital market. Money market, capital market and securities market represent the dynamic aspects of the economy, through which funds flow between lenders and borrowers. Indian economy has a well-spread network of such markets. Not only this, the Indian economy also has a number of financial intermediaries to aid the economic processes. Money market. A money market is defined as a market for borrowing and lending of short-term funds with maturities ranging from overnight to 1 year. RBI describes money market as the center for dealings, mainly of a short-term character. It meets the short-term requirements of borrowers and provides liquidity or cash to lenders. It is different from stock market. It is not a single market but a collection of markets. The Reserve Bank of India is the most important constituent of Indian money market. Other important players in money market are government, DFHI, Discount and Finance House of India, banks, mutual funds, corporate investors, provident funds, NBFCs, non-banking finance companies, etc. The functions of money market are as follows. It caters to the short-term financial needs of the economy. It helps the RBI in effective implementation of monetary policy. It provides mechanism to achieve equilibrium between demand and supply of short-term funds. It helps in allocation of short-term funds through interbank transactions and money market instruments. It also provides funds in non-inflationary way to the government to meet its deficits. It facilitates economic development. Indian money market is characterized by the presence of both unorganized and organized sector. The informal or unorganized market operates through small-scale moneylenders, indigenous hankers, non-banking financial institutions, NBPI, as well as others outside the control of RBI. The organized money market is regulated by RBI. The most important feature of money market instrument is its high liquidity. It is characterized by high degree of safety of principal and broadly covers the following instruments. '88. General Studies, Mains, Paper 2. Components of money market. The components of money market are as follows. Call or notice money. Money is borrowed or lent for extremely short period. No collateral security is required to cover these transactions apart from promissory notes. Under call money market FNS are transacted on overnight basis. It is also called interbank money market since it is dominated mostly by banks. Under notice Mori marks funds are transacted for 2 days and up to 14 days period. Loans can be renewed up to 14 days and such loans come under notice money market. The interest rate, usually called as call money rate, is determined by demand and supply of short-term funds. Treasury bills, T-bills. Treasury bills are short-term money market instruments, issued by RBI on behalf of Government of India. At present, CE types of treasury bills are issued through auctions, namely 91 days, 18% days and 364 days treasury bills. There are no treasury bills issued by state governors. Interest is determined by tracked forces of demand and supply. These are also issued under Market Stabilization Scheme, MSS. Bills are highly liquid and are sovereign zero-risk instruments. LIBOR. The London Interbank Offer Rate CS the average interest rate estimated by leading banks in London that they would be a RGCD if borrowing from other Barca is primary benchmark along with Euribor for short-term interest rates around the world. MIBOR. The Committee for the Development of the Debt Market studied and recommended the Molasses for TE development for her CH mark rate for the call Mori Murkat NS had doubled and arched the NSE Mumbai Interbank Fid rate, MIBID, ARD NSC Mumbai Interchain Offer Face MIBOR, for the overnight Mori market or 15th UNC, 996. Accordingly, the MIDI RIBOS is used as a benchmark rate or majority of Ds struck for interest rate swaps, forward rate agreements, FKing 8 debentures ARD term CPESTs. Certificate of Deposit, CDs. The scheme of CDs was introduced in 1989 by RRL. The main purpose was to enable the commercial banks to raise short-term funds from market. At present, the maturity period of CDs ranges from 7 days to 1 year with minimum amount at 1 lakh. They are freely transferable per the standards applicable to other Damat securities. CDs are issued by scheduled commercial banks and development financial institutions and rank next to T-bills in terms of low-risk category instrument RRBS, and local area banks cannot issue CDs. CDs are secured, negotiable promissory notes issued at a discount to the face value. These are similar to term deposits except that they are tradable in the market. Commercial papers, CP. Commercial paper, CP, an unsecured money market instrument issued in the form of a promissory note, was introduced in India in 1995 with a view to enable highly rated corporate borrowers to diversify their sources of short-term borrowings and provide an additional instrument to the investors. CP can be issued for maturities between a minimum of 7 days and a maximum of up to 1 year from the date of issue. However, the maturity date of the CP should not go beyond the date up to which the credit rating of the issuer is valued. Commercial bills. Commercial bills are short-term, negotiable, and self-liquidating money market instruments with low risk. A bill of exchange known as trade bill is drawn by a seller, drawer, on the buyer, draw wheel to make payment within a certain period of time. These trade bills, when accepted by commercial banks, are called commercial bills. Generally, the maturity period is of 3 to 6 months. Commercial bill can be resold a number of times during the usance period of bill. These are also tradable. The commercial bills are purchased and discounted by commercial banks and are rediscounted by financial institutions like Exim Banks, SIDEI, IDBI, etc. In India, the commercial bill market is very much underdeveloped.
సేమ్ లొకేషన్ లో ఫోటోలు చూడు కానీ ఎవరికి తెలియదు
వాళ్ళిద్దరు మంచి
Money market and capital market. 89. The repo market. Repo was introduced in December 1992. Repo is a repurchase agreement, meaning selling a security under an agreement to repurchase it at a predetermined date and rate. Repo transactions are effected between banks and financial institutions and among banks themselves. RBI also undertakes repo. In November 1996, RBI introduced reverse repo. It means buying a security on a spot basis with a commitment to resell on a forward basis. Reverse repo transactions are effected with scheduled commercial banks and primary dealers. Problems associated with Indian money market. The Indian money market is considered as progressive money market in developing countries. However, it still suffers from several disadvantages. This proves hindrances in development of money market in India. Some of them are outlined below. Black Circle. The Indian money market is divided into the organized and unorganized sectors. The organized sector comprises of the legal financial institutions backed by the RBI, whereas the unorganized segment consists of various institutions such as indigenous bankers, village moneylenders. There is lack of integration between these two, which limits the full maturation of money market in India. Due to multiple rate of interest charged by banks, which are predominant player in money market, confusion and ambiguity is created among investors. Black Circle. The Indian economy with its seasonal structure suffers from frequent shortage of financial resource. The lower per capita income, low saving rate and lack of banking habits are among the major reasons for it. In the Indian money market, various investment instruments such as treasury bill, commercial bills, commercial paper etc. are used, but given the size of population and economic growth, these instruments are insufficient. Hence, further more instruments are needed. There are less number of dealers in the short-term assets who act as mediators between the government and banking system. Reforms to strengthen the Indian money market. On the basis of recommendations of S. Chakravarti Committee on the Review of Working of the Monetary System and Narasimhan Committee Report on the Working of Financial System, RBI has initiated a number of money market reforms as listed below. Deregulation of interest rates. RBI has deregulated interest rates, and rates were permitted to be determined by market forces. Reforms in call and term money market. To provide more liquidity, RBI liberalized entry into call money market. At present, banks and primary dealers operate as both lenders and borrowers. Lenders other than UTI and LLC are also allowed to participate in call money market operations. In October 1998, RBI announced that there should be no participation of non-banking institutions in call term money market operations, and it should be purely an interbank market. Introducing new money market instruments. In order to widen and diversify the Indian money market, RBI has introduced many new money market instruments like 182 Ks treasury bills, 364 days treasury bills, CMBS and CPs. Through these instruments, the government, commercial banks, financial institutions and corporates can raise funds through money market. They also provide investors additional instruments for investments. LAF, Liquidity Adjustment Facility. Through this, the RBI remains in the money market on a continued basis by undertaking repo transactions. LAF adjusts liquidity in the market through absorption or injection of money in the market. Refinance by RBI. At present, 2 schemes of refinancing are in operations: Export Credit Refinance and General Refinance. RBI has kept the refinance rate linked to MCLR.
తాగింటేమో చెడుపు
90. General Studies, Mains, Paper 3. The Clearing Corporation of India Limited, CCIL. It was registered in 2001 under the Companies Act, 1956, with the State Bank of India as chief promoter. CCIL clears all transactions in government securities and repos reported on NDS, Negotiated Dealing System, of RBI and also rupee, US dollar foreign exchange spot and forward deals. V. Regulation of NBFCs in 1997, RBI Act was amended and it provided a comprehensive regulation for non-bank financial companies, NBFCs sector. According to amendment, no NBFC can carry on any business of a financial institution including acceptance of public deposit without obtaining a certificate of registration from RBI. They are required to submit periodic returns to RBI. Discount and Finance House of India, DFHI. In 1988, DFHI was set up by RBI to strengthen the bill market and provide short-term liquidity. It is jointly owned by RBI, public sector banks and all India financial institutions, which have contributed to its paid-up capital. It is playing an important role in developing an active secondary market in money market instruments. In February 1996, it was accredited as a primary dealer, PO. The DFHI deals in treasury bills, commercial bills, CDs, CPs, short-term deposits, call money market and government securities. Capital market. Capital market deals with medium-term and long-term funds with maturity of 1 year and above. It refers to all facilities in the institutional arrangements for borrowing and lending term funds, medium-term and long-term. The demand for long-term funds comes from private business corporations, public corporations and the government. The supply of funds comes largely from individual and institutional investors, banks and development financial institutions and government. The importance of capital market in economic growth is discussed below. Black circle mobilization of savings and speeding up of capital. Formation. Black circle raising long-term capital for promotion of industrial growth and infrastructural investment. Ready and continuous market for purchase and sell of securities along with easy liquidity. Advisory services and technical assistance to entrepreneurs by financial intermediaries. Reliable guide to performance and financial position of corporates. Effective utilization of funds in the public interest through proper channelization of funds. Development of backward areas through provisioning funds for projects in backward areas. Black circle bring in foreign capital and foreign technology, which is important for economic development. A medium for risk management by allowing the diversification of risk in the economy. Types of capital market. The types of capital market are broadly divided into two parts. 1. Primary market. Primary market deals with the issuance of new securities, preference shares and debentures and bonds by the companies, public sector enterprises or government directly to the investors. G-Secs and treasury bills form the part of debt bond market, whereas IPO, PPO rights issue and private placement are part of equity market. Some of the major instruments of primary market are 1. Initial public offering, IPO, is a process under which company issues shares for the first time and raises capital for its business. An IPO issue is generally assisted by an underwriter, which helps it to determine what type of security to be issued, best offering price and right time to issue. Money paid by the investors for shares under IPO goes directly to company, unlike for secondary shares where money passes between investors.
సాధారణం రమ్మల్లి అన్నాడు ఒకరోజు. అట్ట కూడా ఉంటారా చూడు.
money market, and capital market. 91.
ఇంతకుముందు
Follow on public offering, FPO. Once listed, a company can further issue new stocks by means
చెప్పు ఇన్నే ఉన్నారు.
of FPO and rights issue to raise more capital. Rights issue, under RE. New shares are offered to existing shareholders only in proportion to their shareholding, while FPO is open to all investors. S. Private placement. It is another mechanism of direct sale of new securities known as private equity to big investors, usually referred as institutional investors. This process saves the time and cost as it does not require procedural requirements needed in IPOs and rights issue. V. Offer for sale, OFS. This is a new instrument, similar to IPO and FPO, but the process of ops is simpler. OFS is cost and time effective and is also more transparent than IPO and FPO. 2. Secondary market. This refers to trading of already issued securities. It is composed of industrial security marker or stock exchange market and gilt-edged marker. Speculators and investors can trade on stock exchange as there are potential buyers and sellers. For the management of the company, secondary equity.
కాకపోతే ఈ పరిస్థితి ఏంది చెప్పు.
Markets serve as a monitoring and control conduit by facilitating value-enhancing control activities, enabling implementation of incentive-based management contracts and aggregating information, a price discovery that guides management decisions. Speculation is an important feature of share market. A rational speculation made on the basis of actual performance of the company leads to better resource allocation in the economy, but an irrational speculation for short-term gains can result in an asset price bubble or financial meltdown. Secondary market could be either auction or dealer market. While stock exchange is the part of an auction market, over-the-counter, OTC, is a part of the dealer market. Reforms in capital market. Indian economy is characterized by highly underdeveloped capital market which hampers resource mobilization for large-scale infrastructure development. In pursuance of this, government has instituted many reforms. Few of them are outlined. Disclosure and investor protection. Guidelines. Under these guidelines, all primary issuers have to disclose various types of financial information to SEBI before issuing the new shares. After getting listed, companies have to publish unaudited financial results. Free pricing. Since 1992, the issuer along with underwriter can freely decide the price of new share without any role of SEBI. But they must disclose the method used to arrive at such price to SEBI. The underwriter usually employs book-building process for the discovery of price of an issue.
నీ టార్గెట్ తెలుసు కదా.
Modernization of trading infrastructure. The Indian stock exchanges were modernized in 90s with computerized screen-based trading system sets under which the demand and supply of shares are electronically matched.
నీ ఏటీఎం వద్దు.
It cuts down time, cost, risk of error and fraud and has improved liquidity and price discovery process leading to improved operational efficiency. Dematerialization. Since 1996, share delivery is made through electronic book entry into the Demat account of the buyer. Even bonds and debentures are allowed in Demat form. The advantage of Demat trade is that it involves paperless trading. Depositories are the intermediaries that facilitate dematerialization by holding and transferring the e-scripts of the investors. NSD and CSDL are two Indian depositories. It has reduced extra transaction cost, shortening of the settlement cycle, Settlement is the process under which buyer of the share makes payment and the seller delivers the shares. It is done by clearing houses. Rolling settlement is an important measure to enhance the efficiency and integrity of the securities market. Under rolling settlement, all trading activities executed on a trading day, 1, are settled after certain days, n. This is called T plus N rolling settlement.
ఏమీ చేయలేదు మళ్ళీ నేను కలర్ పోయింది మరి
General Studies, Mains, Paper 3. 92. Basis. Duration. Since the 1st of April 2002, trades are settled under T plus 3 rolling settlement. In April 2003, the trading cycle has been reduced to T2 days. The shorter run of trading cycle has reduced undue speculation in stock markets. It is carried out by the clearing houses. The Clearing Corporation of India Limited, CCI, clears all transactions in government securities and repos and also rupee, US dollar forex spot and forward deals. Liquidity. Capital market. Money market. H. doles in. From single day to maximum of 1 year. Medium and long-term securities such as bonds and debentures. Less liquid as A. More ideas. DIFHI provides a ready market for money market. Share may not be actively traded. Instruments safer as due to governments. Roque bought with redeems in. Short duration of investing and also to financial soundness of the principal payment issuing company may fail to perform and promoters may defraud investors. Issuers mostly comprised of banks. Safety. Buyback of shares. Since 1999, companies are allowed to buy back of shares. Through buyback, promoters reduce the floating equity stock in market. Buyback of shares help companies to overcome the problem of hostile takeover by rival firms and others. However, the limit on the number of buybacks has been imposed by the government. Expected. The possibility of earning is higher. 60 securities are held for longer duration. As is for short duration, it doesn't provide high return on investment. Credit default swaps, CDs. A credit default swaps, CDs, is a financial swap agreement in which the seller of the CDs will compensate the buyer in the event of a loan default or other credit event. The buyer of the CDs is required to pay a premium to the seller and to exchange, receives a payoff if the loan defaults. Credit rating agencies. There are various credit rating agencies such as Credit Rating Information Services of India Limited, CRISIL 1988, Investment Information and Credit Rating Agency of India Limited, CRA 1991. These were set up to meet the emerging needs of capital market. They also help merchant bankers, brokers, regulatory authorities, etc. in discharging their functions related to debt issues. Trading in new products like fires and options have been allowed in the Indian capital markets. Financial intermediaries. Financial intermediaries help in mobilizing savings and supplying funds to capital market. These include merchant banks, mutual fund, leasing companies, etc. Merchant banks perform specialized function I. Advising the company who wish to raise funds from public. They manage and underwrite new issues floated by companies and also determine the time and price of an issue. They also undertake market research and investment management, thus referring then to investment bank. Few big investment banks are Goldman Sachs, Morgan Stanley, Merrill Lynch, etc. Difference between capital and money market in India. Basis. Capital market. Participants. Financial institutions bans corporate. The importance of this distinction arises from the fact that the liabilities of banks are part of the money supply, and this may not be true of the non-banking financial intermediaries. Money market. Restitutional. Participants such as RB banks, financial institutions, entities foreign, investors etc. Instruments equity, shares, debentures bonds. Preference shares X are main instrument. Main instruments are short-term debt instruments such as T-bills, commercial paper, commercial deposits etc. Non-banking financial intermediaries. The most important of the non-banking financial intermediaries are the building societies, hire purchase companies, insurance companies, savings banks, pension funds and investment. Money market and capital market. 93. Trusts. Financial intermediaries hold a very important role in the flow of money in the financial world. The assistance of a financial intermediary is needed by companies who want somebody to act as a middleman in raising money from the investors. Meeting up between these two parties are often very difficult without the help of financial intermediaries. Apart from all the above discussed, financial intermediaries also include mutual funds, venture capital companies, leasing companies, merchant banks, public offering, etc. Mutual funds. A mutual fund is a company that brings together money from many people and invests it in stocks, bonds or other assets. The combined holdings of stocks, bonds or other assets the fund owns are known as its portfolio. Each investor in the fund owns shares, which represent a part of these holdings. Venture capital companies. Venture capital refers to a commercial help to new innovation and the adoption of new technology. The significance of such companies is increasing because of increase in number of persons who have technical knowledge and new methods, but don't have capital to invest. Venture capital brings them together to get mutual benefit. Leasing companies. These companies provide machinery and other equipments on lease basis to the other companies or manufacturing units. Financial leasing companies engage in financing the purchase of tangible assets. The leasing company is the legal owner of the goods, but ownership is effectively conveyed to the lessee, who incurs all benefits, costs and risks associated with ownership of the assets. Merchant banks. These are the institutions that carry out a variety of financial services, including the acceptance of bills of exchange, the issue and placing of loans and securities, portfolio and unit trust management and some banking services. Merchant banks in India manage and underwrite new issues, they undertake syndication of credit, they advise corporate clients on fundraising and other financial aspects. Public offering. An initial public offering, IPO, is the first sale of stock by a private company to the public. IPOs are often issued by smaller, younger companies seeking the capital to expand, but also be done by large privately owned companies looking to become publicly traded. Stock market. A stock market, equity market or share market is the aggregation of buyers and sellers, a loose network of economic transactions, not a physical facility or discrete entity, of stocks, also called shares. These may include securities listed on a stock exchange as well as those only traded privately. The functions of stock market are as follows. The organization of stock exchange provides a ready market to speculators and investors in industrial enterprises. It makes possible the determination of supply and demand on price. The very sensitive pricing mechanism and the constant quoting of market price allow investors to always be aware of values. The stock exchange renders safeguarding activities for investors which enable them to make a fair judgment of securities. Major stock exchanges in India. The major stock exchanges in India are as follows. National Stock Exchange, NSE. On the basis of the recommendations of high-powered Perwani Committee, the National Stock Exchange was incorporated in November 1992 as a tax-paying company unlike other stock exchanges in the country, by Industrial Development Bank of India, IDBI, Industrial Credit and Investment Corporation of India, ACC, Industrial Finance Age Corporation of India, IFCI, all insurance corporations, selected commercial banks and others. In April 1993, it was recognized as a stock exchange and commenced operations in 1994. In October 1995, NSE became the largest stock exchange in the country. '94. General Studies, Mains Paper. Trading at NSE can be classified under two broad categories. I. Wholesale debt market. 11. Capital market. Wholesale debt market operations are similar to money market operations where institutions and corporate bodies enter into high-value transactions in financial instruments such as government securities, treasury bills, public sector unit bonds, commercial paper, certificate of deposit, etc. Bombay Stock Exchange, BSE. Established in 1875, BSE Limited, formerly known as Bombay Stock Exchange Limited, is Asia's first stock exchange and one of India's leading exchange groups. Over the past 137 years, BSE has facilitated the growth of the Indian corporate sector by providing it an efficient capital-raising platform named DOTS. 5 share indices are working under BSE which are as follows. 1. Sensex. It is measured by Sensory Index and at present 30 companies are notified under it. BSE 500. This new index started operation in the year 1999 by BSE and it is the biggest base index. National Index 100 companies are therein. This index and it is coded by the regional share markets. TV, BSE 200. It is the share index of 200 biggest base companies. It is also called DOLX as it also depicts the value of the American dollar. V. Indo. Next, it is established by BSE in Federation of India Stock Exchange, FISE, with the aim of encouraging liquidity among small companies. BSE Greenex. Bombay Stock Exchange on the 22nd of February 2012 had launched a new index called BSE Greenex, which measures the performance of the company's interims of carbon emissions. The top-ranking companies from each sector like power, steel, cement have made it to the new index called BSE Greenex. It has 20 companies from the broader BSE 100 index that meet energy efficiency norms. MCXSX Stock Exchange. It is a private stock exchange headquartered in Mumbai, which was founded in 2008. With starting of business of MCXSX Stock Exchange on the 11th of February 2013 in India, a new share market also started as well. After BSE and NSE, this is the third complete share market in the country. SX40 is a free plot-based index, where 40 companies of different fields will have their shares. Its basic price is finalized as 10,000 and basic date as the 31st of March 2010. However, the SX40 has not started business yet. OTC Exchange of India. Over-the-Counter Exchange of India, OTCEI, was incorporated in 1990 as a company under the Companies Act, 1956, and is recognized as a stock exchange under the Securities Contracts Regulation Act, 1956. The exchange was set up to aid enterprising promoters in raising finance for new projects in a cost-effective manner and to provide investors with a transparent and efficient mode of trading. The OTCEI is no longer a functional exchange, as the same has been recognized by SEBI order dated the 31st of March 2015. Interconnected Stock Exchange (ISH) is a national-level stock exchange, providing trading, clearing, settlement, risk management and surveillance support to its trading members. ISE aims to address the needs of small companies and retail investors by harnessing the potential of regional markets, so as to transform them into a liquid and vibrant market using state-of-the-art technology and networking. Securities and Exchange Board of India, SEBI. SEBI was established in the year 1990 and was given statutory power through the SEBI Act, 1992, in order to protect the interests of the investors in securities as well as promote the development of the capital market. It involves regulating the business in stock exchanges, supervising the working of stockbrokers, share transfer agents, merchant bankers, underwriters, etc., as well as prohibiting unfair trade practices in the securities market. All capital market participants must be registered with SEBI, and it can also suspend or cancel their registration. Money market and capital market. 95. Functions of SEBI. The functions of SEBI are as follows. Protection of investors' interest. Restriction on insider trading. Regulates stockbrokers' activities. Regulates merchant banking. Formulates guidelines on capital issues. Regulates working of mutual funds. Monitoring of stock exchanges. Formulates secondary market policy. Investors' grievances redressal. Formulates institutional investment policy. Regulates takeovers and mergers. Promotes investors' education and also waning of intermediaries in securities market. In 2013, an ordinance to amend the securities laws was promulgated, under which SEBI would now have powers. Social Stock Exchange. The SEBI, India's capital market regulator, in October 2021 approved the creation of a social stock exchange to enable non-profit organizations and for-profit enterprises raise funds. SEBI approved a separate framework for social stock exchange for the listing of non-profit organization and for-profit social enterprises that are engaged in 15 broad eligible social activities approved by the market regulator. The social entities can raise funds through equity, issue of zero coupons, mutual funds, social impact funds and development impact bonds. Gilt-edged securities, G-SECs. Gilt-edged securities are long-term, risk-free bonds and dated securities issued by central and state governments, usually called state development loans. These securities are issued at fixed or floating rate of interest on the face value. The maturity can be up to 30 years and minimum investment limit is 210,000 Ferdner. G-SECs are issued in DAMOT as well as physical form. G-SECs can be of various types such as caded securities, fixed interest rates and fixed maturity, floating rate bonds, variable interest rate with a cap and floor rate attached, capital, inflation indexed bonds, linked to CPI, WPI. Accessing global funds market. Indian companies are allowed to access global finance market and benefit from the lower cost of funds. They have been permitted to raise resources through issue of American Depository Receipts, ADRs, Global Depository Receipts, GDRs, foreign currency convertible bonds, FCCBs, and external commercial borrowings, ECBs. Further, Indian financial system is opened up for investments of foreign funds through non-resident Indians, NRIs, foreign institutional investors, FLLs, and overseas corporate bodies 10CES. ECBS. It is a financial tool used to raise foreign money by Indian corporations and PSUs through non-resident lender with an average maturity of 3 years. ECBS comprise commercial bank loans, buyer's credit, supplier's credit, securitized instruments such as floating rate notes and fixed rate bonds, credit from official export credit agencies and commercial borrowings from the private sector window of multilateral financial institutions, etc.
ఒక్క నిమిషం.
ECBS cannot be used for investment in stock market or speculation in real estate. Borrowers can use 25% of the ECB to repay rupee debt and the remaining 75% should be used for new projects. A borrower cannot refinance its existing rupee loan through ECE. The money raised through ECB is cheaper given near zero interest rates in the US and Europe. Reasons behind its popularity is the lower interest rate and increase in forex inflows are